Hello, everybody. Brian Ladd here. I'm looking forward to having another discussion about housing here in July of 2025. It's a vibrant, dynamic, confusing market out there, and we have a lot to talk about today. So it looks like everyone is joining in here. Of course, first login, 20 webinars in a row is our all-star Gary Lacrosse, without which we could never have a webinar. Holding strong. Jeffrey, Jim, Judell, John, Julia, Kathy, Chris, Leland, Mandy, Mona, excuse me, Pat, Rachel, Renee, Rich, Robin, Rod. Thank you all for joining us today. We have a lot of fun things to talk about, and I would love to be able to create this as a two-way conversation. So as we go along today, what I would love is put out Q&As, put out chats. You should have that functionality here in the webinar. We'd love to be able to answer your real-time, very specific concerns. And we often feel we feel that talking about those stories or individual questions, individual properties help tell the bigger story. So I've left a lot of room today in today's webinar to have room for that discussion. So I welcome that. We boiled it down to four main themes today. So instead of burying you in data points, what we've really done is taken all these different data points affecting buyers, sellers, micro, macro economy, et cetera, et cetera, et cetera, and boiled it down into four discussion points that help you better understand what's happening here in real estate. So I really look forward to it. Looks like we have a lot of people still joining on, but I want to honor everybody that already got logged in on time. And those that join us later, we'll have a replay of this sent out to everybody. And when you get a copy of this, via email, feel free to forward it along to other people. If you have questions that pop up later, feel free to reply back, send us a question. We're always happy to engage. But Ronald, I'm joined here by two amazing people, Ronald and Aaron. And Ronald, would you mind pulling up a few of those polls? What I'd like to do is kind of get a read of the room because we're not here all together. A few questions about just to kind of see how you're feeling about this market so that we can speak into that. Let's start with buyer behavior. Love to get your thoughts on that. Aaron, how do you feel about how these polls are coming in? Is everyone else see this or is it just me at this point?
I don't know if we can see the results yet. I wish we could vote, Brian, because I think this is such an interesting one for sure.
Yeah,
Yeah.
I see it coming in. So, wow, we're already 25 people and growing. Thanks for all joining us today. So, the first poll, we just want to get a kind of an idea of saying, hey, if a listing's been on the market for 40 days plus days, what's your first thought as a buyer? Let's give this about 15 more seconds. Jump on, throw your comment in, and then Aaron, I'd love you to real time interpret these results.
Yeah, can't wait to see them. So the question, kind of the answers are there might be room to negotiate, something's wrong with the property, an immediate jump to it's overpriced, it hasn't found the right buyer yet, or hey, it's a good time to jump in as a buyer and I'm more likely to schedule a showing. So I'm interested.
Perfect. Ronald, flip those live, share those results. Okay,
Okay.
Aaron, what do you think?
Yeah. So might be room to negotiate is interesting. I think that's about what we thought it would be. That it's overpriced, I think is probably something we would have assumed as well, about a quarter of the folks. But this is interesting to me, Brian. It hasn't found the right buyer yet, is a quarter of the folks as well. And I think that's might be some of our sellers and just kind of a patient perspective as well. So that surprises me.
Yeah,
But
I would think that it just hasn't found the right buyer yet is probably coming from people that have been in the real estate market longer and they have bigger than the pandemic era framework in their head to understand that 40 plus days is a really quick time to get a contract. Historically, we're just having to kind of do a paradigm shift and readjust after coming out of the pandemic. And I think that's going to be the theme of what we talk about today. And what we're going to see is big shifts are happening, but these big shifts are bringing us back to normalcy, which is hard for people to understand. And so, if I were to, you know, give my number one response, it would probably be somewhere between there might be room to negotiate, but most likely is that it hasn't found the right buyer yet. So it's kind of in that zone. But Ronald, can you pull up the second poll real quick as well? Aaron, do you want to walk us
yeah.
through this one?
So at what point do you start to think a home has been sitting on the market too long? So is that 40-day threshold that we just asked about right? Or are you thinking under 15 days is a good length of time to be on the market, 16 to 30, 31 to 45? And then lastly, I don't pay attention to days on market. And then afterwards, we will share with you what the current days on market is because I don't want to color your opinion here.
Yeah, and I already led everybody to what answer. So I think
Mhm.
that lo and behold, I guess I think everyone's going to say that 40 days is right now.
Mhm.
But let's go ahead and publish that result and get on with things.
Okay, yeah, just about 75% think it's 31 to 45 days, but a lot don't pay attention. So a quarter of you don't even pay attention to days on market. So that's interesting for us to see. It's certainly a big part of our talking point, but good to know that the public overall doesn't gauge it as well as much. So
Wonderful. So everyone, come at us with your Q&As and chats as we go along. Let's create a 30-way conversation. But let's get down to why everybody's here today. Let's go over those four main themes that I was talking about. We're going to use a lot of different data points to talk about four main themes so that hopefully at the end of this, there's clarity in your head of kind of how it all comes together. And I think our goal is always to say headlines are interesting, they're emotional, but they don't inform you enough to make good decisions as a buyer or seller. So we always try to distill both through our experience on we have at the Lad Group at any one time about 50 transactions in escrow in negotiation. And so what we try to do is try to bring the real-time data of what we're seeing and kind of the macro perspective into helping you understand the market so you can more clearly move forward. So with that, let's go ahead and start talking about seller inventory. What I'd like to do first is kind of give the point that I'm talking about. And then what I'd love from Aaron is how this affects you as a buyer or seller. So I'll be more data oriented macro, and then Aaron can boil this down into as a buyer, as a seller, suggestions on how to act. So what I'd like to start with is that seller inventory is rising. You're probably seeing it in the headlines, and it is increasing faster than buying activity. A lot of people have felt this shift, and there are buyers, but they're moving cautiously. I think there's three main data points I'd like to flip to or discuss, and then we'll flip over to a chart that helps kind of drive this home. Number one, months of inventory. We're up to about 5.2 months of inventory, and that's up from about 2.1 months in July of 2022. Number two, a lot of people say, hey, listings for sale are up 20%, 30%, and kind of, what data point you're using and what your filters are and what property types, et cetera. But when a lot of times people say, hey, active listings are up 20%, but sales are only up 7%, isn't there too much inventory? Won't pricing crash? And I want to get to that, but that's just a data point. What this indicates to me is that there are more choices for buyers, but it hasn't flipped into buyer's market. A lot of journalists and people are trying to say, oh, it's a buyer's market in real estate. We're not there. We're not there yet, maybe not ever. But what I want to do is kind of talk about just the data. And this slide here is a number that Redfin came up with nationwide. It looks pretty dramatic because they sandwiched it between, just over 1 million to 2.5 million. But they did an estimate of how many active buyers and active sellers there are in the market. And as you can see in the 2020, 21, 22 eras, we had simply way more buyers than there were sellers, which is what drove our prices up 10, 20% a year when historical average was 3 to 5%. A lot of people kind of see this flip of saying, hey, there's more sellers back, fewer buyers. And there's a lot of things to this. A lot of sellers were waiting on the sidelines. A lot of buyers are still waiting for interest rates to come down. But I think this is kind of the data points that's scaring everyone. But I'd like to get more nuanced and micro on what's happening here in the Bend market. Aaron, do you want to take this one?
yeah, absolutely. So specifically what we're looking at here is the kind of inventory. And, when we talk about supply and we're talking about it in months, we always say that if no other homes came on the market, this is how many months it would take for them all to be sold. And we've always said that the threshold here is 6 months of inventory. And that's kind of where you're right in the middle ground between being a buyer's market and a seller's market. And as you can see, we're hovering right below that, but you can also see our historic low was, in 2021, where we were at 1.9 at one point, which we know what that led to. So we've enjoyed kind of the healthier kind of shift as we've moved a little higher with the inventory. It's given some breathing room. It's allowed for some inspections. It's allowed for, God forbid, a contingency every now and again. But I think what's interesting now is that we may be broaching and kind of reaching that threshold where we're shifting into a true buyer's market, and we're just having to educate our sellers as to what that means and how that shift will take place.
Yeah, and what I take away is balance here because a lot of people are saying, hey, inventory's doubled over the last 2 years. this is a time where prices are going to come down. It's an absolute buyer's market. Historically, National Association of Realtors have always defined a balanced market somewhere between 5 and 7 months. There's a lot of new data that's coming out and saying, hey, a balanced market might be 4 to 6 rather than 5 to 7. Either one, we're still into that healthy kind of balanced market on the amount of inventories compared to buyers. Obviously, if the trends continue and buyers continue to diminish and sale or listings continue to climb, obviously we could kind of push through this. But where we stand right now is the same we were in 2016, 2017, 2018, 2019, 2020. So I wouldn't think that many people here would say 2013, 14, 15, 16, 17, that kind of decade in there was a, an unbalanced buyers or sellers market. And yet that's where we're at. But a lot of people are wanting to oversimplify and saying it's a buyer's market. And I think this data helps kind of, this was data that was updated, just in June. So maybe it's changed a little bit since then, but I think that we're kind of more balanced than a lot of the headlines lead us to believe. Same with active inventory. If you look at active inventory, this is the amount of, and I believe this is single family listings in our MLS right now. But what it shows is we're at about the 20-year historical average. We're just coming off the anomaly years, right, Aaron?
Yeah, absolutely. We're coming up. And, I think it's really interesting. And then I can kind of, delve into it. The inventory that's risen now at this point has allowed buyers to shop again. And so I think if you can kind of see the delta here and how drastically that's changed, the buyers don't necessarily know how to handle all that right now. And so what we are seeing is a little bit of an analysis paralysis in general, because the buyers now suddenly have so many homes to choose from, given this active inventory and how much this has changed, that they're kind of circling and looking at a lot more homes than they typically would have, and feeling like they, may not need to make a decision just yet. And it's really coloring and continuing with this inventory overgrowth that we're seeing.
Yeah. And so Ron just sent in a question. He's saying, we have, let me see what he said. I see many sellers with a 2021 pricing mentality. What, if anything, will change pricing? Great question. Let's definitely get to that. What we're seeing is that a lot of sellers, you know what? I'm going to put a pin in that because there's a couple data points that'll really drive that home here shortly. But great question. Keep them coming, everyone. Thank you. The next thing I want to talk about is sales volume. So sales volume has softened, but it's stabilized. If we can kind of go to gross volume, we can go to number of sales. Right now, the market in Bend is selling about $250 million of single family homes a quarter, which is a lot, right? That's just over $2 billion of sales. But that's down from about 800 million, or about $3.5 billion a year back during that pandemic, kind of 21 year. So we're down about a 30% in volume, but we're still above where we were in those pre-pandemic eras. And the other point that I think we'll get to here in a second is sales absorption. And this goes to Ron's question of saying, hey, are some sellers unrealistic? What we're showing right now is that about 20%, 20% of the homes that are on the market are selling. And that sounds scary because, in the 21 era, 96% of the homes, so like if 100 homes came on the market, 96 of those homes would sell. We're currently in a market where about 20% of the homes are selling. So the conversation that we're having with our sellers right now is, if only 20% of the inventory is trading, are you in that 20% when it comes to price, positioning, whatnot? And we might see some big price corrections from people that were unrealistic, but often those sellers have to be on the market for 6 or 9 months to really drive home, because the data is confusing and selling their home is emotional. But 20% sounds scary, but we'll get to that in a second. We've got some data points on that. This was simply the sales volume that I was talking about, and you can see kind of the huge annual cycles. I mean, this is what I get upset about a lot of times. You'll see the bulletin talking about volume. Volume's up 50%, volume's down, 50% month over month, or prices are down 10% month over month. And realistically, we have this big cycle every year that kind of January through January, but it's been very consistent. And when we look at the sales volume of what's occurring right now, even though buying activity is quote unquote down, we're back to where it was in 2018, 2019, 2020. So, hopefully this helps put it in perspective that those headlines are a little bit misleading. Aaron, do you want to talk about the absorption rate a little bit?
Yeah. So the absorption rate, like you've indicated earlier, is down. It's down to only 20%. And, at one point you can see here at the peak, it was 96%. So that means that the homes that came on the market, 96% of them sold. The ones that didn't either withdrew or, pulled off for personal reasons or whatever it might be. Maybe they expired as listings and just decided to come back on later or remodel or whatever that might be. Right now, we're seeing that this is, right at 20%. And this is unique because it means that if there's, 10 homes that are like yours, only a couple are going to go pending in the next couple of months. And so I think it's important to know this. And from my perspective, when we're guiding sellers, what this means is that your home needs to be in the top 20% of performance, if you will. It needs to look, the best. It needs to present well. It needs to be showable. It, kind of all of the elements that we can control. And so we don't share this to scare folks, but we do share this to kind of help indicate that, if your home's not moving, it is probably because it's not in this top 20%. And what can we be doing to move the needle to get it there? I think is the big conversation we're having now.
Yeah, and I mean historically, absorption is right around that 20-22%. And even in the era that I keep on talking about, the 2010 to 2020 era, that's about where we were. What a lot of people got used to, especially sellers, and now we're going to start driving home Ron's point, they would be happy overpricing because when you have 90% absorption, that means out of 100 homes that are put on the market, 96 of them or 96% of them are sold. They felt that the market would eventually catch them. That one buyer would eventually come. The pricing will eventually catch up to where I'm at. And it would kind of cure overpricing. We are definitely not in a point where pricing will be cured by the market. But that gets us to our next point of prices are holding their ground. And so despite some slower sales and growing inventory, the median prices really aren't falling. And shame on the bulletin for putting that article out there saying prices went down, median price went down 10% in June. It was a bad data point. And median price, what it was is it was a reflection of January, February, March. There was a lot of high-end homes that traded at $2, $3, $4 million. And when those homes didn't trade in June for that data point, it showed a 10% drop in median price. But if you look on a house by house basis, prices are stable. And so, right now the median price depends on what you want to incorporate into the data set, but we're somewhere between about 775 and 800K for Ben, uncomfortably high, undoubtedly. And it's been about that for the last 24 months. So prices are not dropping. Prices are dropping for homes that are overpriced. And when a buyer is looking out there at a specific home, I think what they have to do is say, okay, what a lot of buyers and buyers agents even mistakenly do is they use that point as the starting point at which they're negotiating, saying, and what they haven't done is a true standalone analysis of what that home's value is. When we go to show a buyer a home, we're saying, hey, this is only a data point. A lot of times we feel the home is perfectly priced and we're saying, hey, you can try to negotiate. We can try that for you, but you're not making a mistake buying at the list price. There are other times where it's wildly overpriced and you have to do a 10%, 8% off a market or off a listing price offer just to bring it down to where it should be. Doesn't mean it's a bad home, doesn't mean the market is down 8%. It's a data point that seller grabbed out of the air, or that agent grabbed out of the air. It's just one opinion of value. And then there's often other times where it comes on the market and we're like, hey, based on the data we're seeing here, we think it's undervalued. So go ahead and pay that price. So we really need to keep that in mind. We're still up, obviously, from pre-pandemic. We're still up, 60% over the late teens. Super uncomfortable, right? And while there's slight variations on pricing, we're not seeing a lot of seller motivation to drop significantly because we are still finding buyers for appropriate, with an asterisk, for appropriately priced homes. Right, Aaron? Can we talk about kind of how this is leveled off the last 2 years?
Yeah, and I think it's good to go back and look at 2022, 23. And I think this is important to watch because if you watch from 19, well, really 20, all the way up to 22, you see how much it was, trending upward. And so it was common in 22 for the sellers to extrapolate up when they went to go, my neighbor, yeah, when my neighbor listed for X, I want to, list for X plus 2%. And they would just keep continuing up. And
Or
so,
10% or
or 10% or
20%.
whatever they wanted to do. And so what we found was that was really where kind of some of the correction and some of the, adjustments needed to come in. It took them a while and all of us to adjust back down to, kind of the new interest rates and then the reduced buyer activity because of that, and really affordability because of that. And so that was where kind of the biggest correction. And then this last bit has just been kind of some fluctuation in terms of, just overall seasonality. And then, yes, some price tinkering from sellers who still, are kind of have thoughts pre-pandemic. The one thing that I will say is that the pandemic allowed, because of that absorption that was 96%, it allowed for sellers to kind of get away with not presenting their homes quite as well, or not having, kind of some flawed homes were still moving. And so now I think, that the market is really telling that story a little more thoroughly, in that, a flawed home, needs to have a delta to it in terms of price, or a home that doesn't have quite as an appealing of, something needs to account for that in their pricing. And that's something that I think sellers need to adjust to a little bit.
Great. Yeah, thank you, Erin. I just got a question here from Rachel. She said, where is this trend going, a year from now? Is there more risk as a seller kind of waiting? Great question. And this is where I'm going to hesitate a little bit, because it's asking me to pull out the crystal ball. The trends that we're seeing is more balanced activity. The factors that would drive prices upward would be decreased interest rates, because we've seen over the last 2-3 years, since interest rates went from 3 to 8%, anytime there's a decrease in interest rate, whether it was from 8 to 7.75 or 6 to 5.75 or 6.5 to 6.25, anytime we saw a drop in interest rates, buyers re-enter the market. So what I'm comfortable with is that there is still buyer demand, but they're simply priced out of the market, right? That purchase price, that mortgage rate, they just can't get in, but they want to get in. That's very different. When we look at all these charts that are 25 years long, unfortunately, I've been involved in the real estate market 52 weeks a year, that full 25 years. So I have a little bit more of a historical perspective. There were times in the Great Recession, even during kind of the dot-com bust in the early 2000s, 2000, 2001, whatnot, where regardless of how you priced your home, a buyer wasn't there. You could do a 30% price off. Interest rates could be at 3%, go from 5 to 3. It really didn't matter, because the buyers, we kind of used up all of our buyers, and it was like creating demand where there was none. In a historical perspective, I still feel that there's buyer demand to be met. People still want to buy homes. The rush, people moving here has slowed, but we're a more mature market. When people move to Bend, they move not just for lifestyle, they move for jobs. I'm sitting on the Chamber of Commerce board of directors, and it's amazing how many people are coming in because they're attracted to jobs for the job market of Bend. People that have been in Bend for decades, that would absolutely make their heads spin, that people would relocate here for a job, not lifestyle, and career advancement. So when I look at the historical perspective on the amount of homes that are available in Bend, the urban growth boundary constraints that we have. By the way, I'm doing a really fun Bend 101 October 7th over at Oregon State University, where we're getting really granular into the urban growth plan, the last one that was done, the new one that's going to be coming the next 5 or 10 years, where we stand on inventory. That one's going to be super robust, and I invite you all to come to that. Send us an email. We'll set aside a ticket for you. But to go where that trend is going, and I know this is a long-winded answer, it really depends on if interest rates come down. I foresee increased buying activity, which would push prices up. The only thing that would, it's supply and demand, right? The only thing that would really kind of push those prices down is if seller activity and listings continue to grow exponentially. We saw back in here, and I'm going to go back through some slides, back in 2008, 9, 10, we got up to 30 months of inventory, and we're right now at about 5. Where I saw that price tip over and prices soften were about 8, 9, 10 months, where the prices started to go negative. And that makes sense, right? If someone's trying to move on with their life, they can put their home on the market for a summer. But when you start getting up towards a year, people really need to get on with life, and they're going to have to start making concessions to make that happen. And we're just not there yet. Whether our inventory goes from 5 to 6 to 7 to 8, 9 months, that's tough to say. But my sense is that we're going to have a fairly balanced market for the year to come. But I'm going to encourage sellers to not look for some magical event that's an unknown to happen to make their selling decision. There are times in real estate where selling is not a guaranteed. It's not like a stock where you can just hit it and there's billions of buyers around the world and they'll absorb it at a certain price. Real estate is not a perfect market. It's an emotional market. It's a lifestyle. It's an investment. It's a lot of things, and it's often complicated. And sometimes when a seller needs to make an exit in short timing, it doesn't always happen. What we do have right now in this market is an exit. We do have buyers. If you're appropriately priced, we're going to find you a buyer. And so it's really the trade-off of, okay, if you've been on the market for 2, 3, 4 months and you don't have offers on the table, either the home, it's marketing or it's market. If your home is not properly marketed, you're not getting showings, they've never done an open house, there's not a lot, then you really need to test the marketing on a listing to make sure. But if all that's in place, you really have to get to market and look yourself in the mirror and be like, am I willing to make price reductions? Because buying activity is happening. We're still having sales volume at 2018, 19 levels. So if buying activity is happening and it's not selling, does a price reduction and a guaranteed or more guaranteed sale, more probable sale this year, is that worth more to me than the risk of waiting for lower interest rates in the future and stabilization in seller volume? So, and I know that's kind of a long-winded answer, but their plan is so specific. And we do have enough buying activity right now that we can make a sale happen. It's just, is it at a price that's in alignment with your goals for your assets? Aaron, is that a kind of a fair long-winded synopsis on that question?
I think it seems fair. And I think if Steve were here, he would bring up the age-old thing, which is you need to you can't time the market. You need to really think about your personal perspective and where
Yeah.
you need to be with your home sale. And if
Yeah.
this year, how impactful it would be if you need to come on next year. And, at what point is the time value of money important? And at what price do you want to sell your home, and all those layers for sure.
Yeah. And so I think what a lot of sellers need to get realistic and be like, hey, if 20% of the homes are selling and they're selling and I'm not, what is it going to take? Like, sit down with your agent at the Lad Group or elsewhere and say, okay, let's look at every home that's a competitor of mine. If my home's $1 million, let's look at everything from 800 to 1.2 in this area. And let's go pick out 20% of those homes. And if we can find more than 20% of those homes that are better positioned, either through they're newer or they had updates or they're better presented or they've got better photos or whatever, if 20 and their pricing is better than us, if you start to get to 30, 40% of those homes are better than yours, I think we start to get into that unlikely range of selling. And so I think it's kind of a case by case basis. But let's talk about buyers. So this next shift slide here is buyer behavior is shifting a little bit. So buyers have more time, they have more inventory, and perhaps, or not perhaps, they do have a little bit more negotiating room. So this is a very large shift from the previous years. And I think that shows up in a couple ways. Right now, the average sale price to original list price is about 96%. That's down from 104%, which is crazy, which meant that the average sales price of the home was 4% higher than the listing price back then. And days on market for pending property. This is not for every property because there's a lot that simply aren't selling. So what is that? That's infinity. But the homes that are actually going pending is just over 3 weeks. I think we're at about 23 days right now, but that's a triple of what it was back in 2021. And then the final piece of this is that price reductions are on the rise. So about a third of the properties in Bend have seen a price drop in the past 30 days. And those that hit the magical number are selling right away, despite being on the market for 30, 60, 90 days. What's reassuring to me is at the right price, there's a buyer in this market. Aaron?
Yeah, absolutely. And we actually did just pull the days on market as well for everything over 1 million. And that was only about a week longer, which surprised me. It was 34 days. And I found that interesting because historically, the luxury homes take longer. So I just
Yeah,
thought,
historically, I mean, luxury homes used to be measured at 90 to 120 days, at least a quarter of the year, when standard housing was a couple of weeks. So usually it's a large multiple, which shows that the luxury activity, despite what people are talking about, are selling, correct?
Yeah.
Luxury homes. Aaron, do you want to talk about this as far as, because you work with a lot of our sellers and buyers about percentage of original listing price? I talked about it briefly, but just kind of talk about how this looks historically.
Yeah, and it's important distinction here that what we're saying is from the original list price, not to the kind of the reduced sale price to where it finally closes at. So what this
Yeah.
is comparing is the original list price that it first came on at and what it finally closes at for the ones that did close. This shows that there's about 4% worth of negotiation, if you will, and or price drops kind of baked in. So when we're speaking to our sellers now, we're usually pulling this number specific to their niche of product, and then we're kind of providing that number up front in, while we're talking with sellers before they even list, so they can kind of prepare themselves that this is about the amount of negotiation you can expect. It's helping deals go more smoothly because I think the more sellers can be prepared. What we don't want sellers to do is say, oh, great, I'll pad my price by 4%. And then I'll, bake it in and then it'll be fine, because that is not true. If you are overpriced, you will be punished in the market, and it's just a fact. And so if you're overpriced, the buyers are very savvy right now and they will see past that, and it will sit longer and get less showing activity for sure. So
Yeah, what we found is, we have charts on this from the past. I'm going to need to go dig those up. What we often found is that the homes that were overpriced were usually penalized kind of triple the delta in which they overpriced, which means if they overpriced the home by 2 or 3%, it usually sold at 6 to 9% lower than the average in the market. And so we always caution our sellers of saying, hey, what about an extra 100 grand? People would negotiate off. The problem is that creates increased days on market. It creates less offers, and then it creates a series of price reductions. And we're not afraid of a price reduction or two to get you perfectly aligned. That's pretty normal. Third of the homes in the market this month did that. But what if you're way overpriced and all of a sudden you have months of price decreases? People extrapolate that trend line, that falling, and it's like catching a falling knife. And they're often punished, and the homes sell far below what they could have if they had been originally priced. So sorry, I had to get that off my chest. We've had that
well,
discussion
and I would just throw back,
3,000 times over the last 2 decades.
it's so true. And I would throw back at you, we often get the question or, statement from sellers, well, it only takes one, so we'll just wait it out for our one. What would you say in response to that seller, Ryan?
Yeah, so the only take one, then it only takes, you have to be that one property. That's how, if someone's willing to pay more for yours or be that exact right fit, you have to look at everything out there and be like, if I had to pick of it 50 homes in my competitive price range, am I the one home to match that one buyer? And often when you remove the emotional connection, especially your primary residence, away from that question, and you look, there's probably 5 or 10% of the inventory that's out there that's equally as attractive. And if you're waiting for just one, you're not that, you've got a 1 out of 10 or 1 out of 20 chance, whatever that is, of being that match the one buyer to the one seller. And so I think in a crazy market like 21, where everything's sold, eventually they'd get to your home. That ship has sailed, thankfully. We're in a much healthier market, and we're past that. Final slide, and then we're going to open it to questions. So if anyone's still here and has a question, please put it in the Q&A, please put it in the chat, or we can flip on your microphone and let's have a conversation. The final one, this is pretty simple. This shows days on market. This goes to what we talked about before. And right now, we're at that, 23 average days on market for well-priced homes. And this is for the homes that actually went under contract. This doesn't have any of the ones that are still in the market, because the average days on market overall in the market would be kind of 2 to 3 times this. If you include unsold inventory, it'd be more 50, 60, 70 days, something like that. I don't have that data point, excuse me, but historically it's about 2 to 3 times what the pending average is. But you'll also see how this is very cyclical. And when you start to get to the end of the year, September, October, November, December, it often takes 2 to 3 times as long to sell that home. And the most probable time to sell is February, March, April, May. Aaron, do you want to talk about this before we we
Well,
end this,
yeah,
the
and
presentation here?
I think you just want to fish where the fish are. And so in the winter, certainly there's less buyer activity, and I think it's important that you're kind of on and look your home is looking its best during this kind of peak season, if you will. I do think it's interesting to look at the seasonality, because oftentimes we do feel a bit of a pickup in the fall that I think folks don't expect necessarily, and so the seasonality of this is interesting. And then I definitely am looking forward to our next webinar, because I think when we look at the days on market, we probably will see a higher number. And we're, glad that we're able to educate folks that are out here on this webinar that, it's just par for the course right now.
Yeah, so if I had to kind of put a bow on, and I don't have access to the Q&A, so Ronald, if you have any questions, just unmute and let me know, or throw it in the chat, is kind of a return to normalcy. And I know I've said this the last few webinars, but we really are balancing buyer and seller activity. Obviously, we can't predict exactly where all these trend lines are going, but if we had to look at rolling averages, what I would presume is that we're probably going to see a continued increase in listing inventory, like it does every year, for another month or two, especially when it goes to absorption. We often find that inventory continues to grow in July, August, September, because the buying activity peak is earlier in the year, and so but then it usually starts to come off. So I would predict the inventory is going to climb slightly. The big caveat on all this is mortgage rates and buying activity. Buyers want to buy, and I think we're going to largely be a product of where mortgage rates are at. Mortgage rates have been stable for the last year or so. Prices have been stable for the last year or so. So my gut feel is that if mortgage rates start edging down, that's going to put upward pricing pressure.
Two more
Any
questions.
questions?
Yeah, there's two here that I think I'll share and let you answer, Brian. So Jim asks, what price points are selling, and does moving closer to the median price point change buyer behavior? So if you're kind of in that median price point range, do you want to shift closer to the median price point to help drive a sale? And I'll let you answer that.
Great question. And his follow-up is, to what degree are buyers concerned about political turbulence and risk? That's great. And I'll answer these in reverse order. So the last question, to what degree are buyers concerned about political risk? I would say that high-end buyers are. High-end buyers are very emotional. And in our last webinar, I actually did a correlation between sales price and the S&P 500, because and it was almost, with median price housing, it was almost completely, there was no correlation. Housing prices did what housing prices did, regardless if the stock market went up or down or sideways. And I would say the same for political turbulence. We're kind of in uncharted time with some of this political, but there's always been some political turbulence. There's an election cycle every year, 4 years for for the president. And what we found is that luxury sales are very dependent on perceived risk to the economy, to perceived stability of the government, to whether their party, left, right, or center, is in power, et cetera, et cetera. And what we find is that presidential cycles greatly affect homes that are 3-4 times the median price. But then we've had a growing stock market for the last 4 months. We've had we have more stability with some of the financial policies and tariffs and things like that, right? And likewise, luxury sales have been very strong the last 3, 4, 5 months, when median price was a little softer. So I would say that median price buyers are less affected by political instability. Fair. But then I would say that what we're finding is selling volume at all price points, and generally, the lower priced homes are often more affected by mortgage rates, because they're struggling to get in. So what we often, and this isn't directly answering it, but the lower price you get, obviously, the more buyers, the wider the buyer pool. The closer you get to median price, the closer they get to qualifying for loans. I think all of that, anytime you move down in price, the more probable the sale is. But we also have a lot of strategies for our sellers that are especially kind of median price or below. Let's say you have a $500,000, $600,000, $700,000 home. This is often where we're saying, hey, rather than a big giant price reduction, if we already feel that we're appropriately priced, that's where a lot of builders nationwide are having success, where they're doing rate buy downs and concessions that help someone get in and buy that interest rate down from 7% to 5% for a couple of years. So there's some strategies where you can say, hey, instead of a $25,000 price reduction, if we offer a $25,000 credit for you to pay to your lender, you can make that 7% interest rate 5% year one, 5.5% year two, 6% year three. These are kind of, buy down strategies. And often that allows them to get their toe in the door when a $25,000 price reduction would only decrease their monthly payment by $50. Buying down their interest rate might decrease their payment by a couple $100. So I would say that if you're medium price or below, there might be some other strategies, unless you're overpriced as well. But if you're already appropriately priced, I would say maybe be competitive on helping people get in to the biggest hurdle, which is mortgages. And then higher end, I think it's more of a byproduct of we're in the stability and emotional kind of gut feel. How do people feel about the world? That affects luxury. Fair?
I do. I think the one thing that I would add is just that I think the increased inventory, and I've said this already, but I'll say it one more time, is creating this, along with political instability, along with the rates and the affordability, are creating a bit of an analysis paralysis. And so buyers will circle and shop, but will not commit necessarily. And so there we are seeing that. And really, marketing is one way, but it's not that the buyers aren't seeing it. So sometimes price needs to be below what we would perceive as market value if you want to be one of those next 2 out of 10 that sells. And so that would be the only caveat I would make to that, especially in that medium price point, highly affected by interest rate kind of niche would be my thought. But
Yeah. Okay. Great. And then the next question Rich just put out there is the price of new construction over existing growing or narrowing? I don't have that data point offhand, but 90% sure that if I dug into that data, I would say it's narrowing. And Rich, you get to a good point here. A lot of times when the market is challenged and builders have inventory, they're more quick to react to the nuances of a month by month basis, or they're more able to do interest rate buy downs, things like that, because they have to sell. A lot of sellers that have their home on the market don't have to sell. If it sells this year, great. If not, and they're not as motivated as builders, because builders have big interest rate clocks, that are all that meter is always running. And if they have an unsold new home that's, unsold for 3, 4, 5 months, that may eat up their whole profit margin on that build. So builders have actually probably been the most competitive in this market because they don't like sitting inventory. They'll also stop construction, but a lot of times they'll do very micro price adjustments. And so my suspicion is that gap between new construction and used inventory is probably narrower. And all the more reason as a resale to be competitive, because you're going to be dealing, especially if you're in the east side competing with a new home in a brand new home that's only a couple blocks away, or if you're in the west side and you're in Northwest Crossing and you're competing with inventory in Discovery West, or whatever it is. I think you need to be a little more cognizant. Although that one might be a poor example because those builders are small that only have 1 or 2 homes available at any one time. But I would say that gap is narrowing in a historical perspective. Wow, that still went 44 minutes with only 4 themes to talk about. But I appreciate everyone here for joining us. Thank you for all the great questions. And if anything pops up after we get off the webinar here, just reply back to either the Zoom invite or the registration, or when we send out a copy of this to you afterwards, we're happy to engage and have a conversation with you. Erin, any parting thoughts?
no, thanks for tuning in, and we're looking forward to doing another one coming up here soon. So we'll keep you informed.
Okay, wonderful. Sorry, we had us buried in the corner, but we're real big people here. And appreciate you all for joining us today. Wonderful turnout. And I look forward to doing it again. So it is June now here, or it's July. We'll be doing another one of these in August. We're going to continue to push these out once a month. We also if you go to our Lad Group YouTube page or one of our websites, we just did a market update that went over a lot of this same data as well. And that's another good way just to kind of hear it from a different angle. So thank you all for joining. Have a good afternoon. There's no smoke and it's not overly hot out. So please go enjoy this beautiful Central Oregon day. Cheers.